So we're in an interesting time to be a real estate investor. Whether you're pessimistic or optimistic, there's plenty of arguments you can make. Hi, my name is Alvin Taveras. I'm the founder of Build to Rent. And in today's video, we're going to be talking about market cycles and what the warnings are before going into a recession. We're also going to talk about my top 8 predictions and what I foresee happening in today's real estate market. Without further ado, let's jump right in. Okay, so each market cycle has 4 phases. That's the recovery, that's the expansion, that's the hyper supply, and the recession. This is a circular loop. Every market cycle is going to have each of these 4 components. So you should expect each 4 of them. Now, it's very easy to predict that we're going to have these 4 stages. The challenge is figuring out when each one will occur. Let's start by diving into the history of market cycles. There are a couple of significant real estate events that occurred over the last 140 years of real estate. You have to start by looking at the Great Depression, which started in 1929, and there was a huge impact into the housing market there. That is the first significant housing market crash we've had in the United States. Then we also had the post-boom. This is coming out of World War II. The VA bill was passed. We've seen a lot of new owners come up using the VA bills, buying homes in the suburbs. This is when we saw the first big boom in housing for the United States, moving away from the cities and more into the suburbs. We didn't have a significant downturn until the financial crisis of 2008. But we have to keep in mind that we went almost 80 years before we had another housing recession. Pretty much the entire time thereafterwards, we were in growth mode. We only had 2 housing recessions the entire time in American history. Now, there's been some small dips, but nothing that was sustained or as significant as the Great Depression and the housing bubble. The other 2 major events that we've seen have both been positive. So we've seen the post-recovery from 2010. This is coming out of the great housing crash of 2008. And then that was huge growth. And then during the pandemic, there was a little bit of a shock, but didn't go into a housing crash. We saw a huge boom. So we've seen over the course of history, 2 major events on the downside. And most of the years, we have multiple years of upswing activities. So this shows that even though we're in a market cycle, not each quadrant is equal to one another. And so the question is, are we in a recession? Are we leading up to a recession? Now, there's a couple of major indicators we have to look at to determine whether we are going to enter a housing market recession. The first is interest rate. So we can all argue that interest rates are high, but they're only high from a short-term historical perspective. Yes, compared to 2 years ago, interest rates are high, but not when you look at 20, 30, 40 years. A 7% and below is considered cheap for a historical standpoint. And so interest rates are a factor. I don't think that they're as high as they were previously, and thus may not be something that we can conclude will cause a housing recession. Then we have inflation. Inflation is up. We've already started seeing the decline. And in this case, inflation actually helped the market appreciation go up. So it actually causes a housing boom with enough inflation. At the moment, inflation seems to have settled. We'll have to keep monitoring this, but it's up to you whether or not you think this is a factor for a housing recession or not. Job growth and opportunity is the 4th one. And under all measures, unemployment is low. And we're seeing stable job growth. We're starting to see wages go up a little bit. Now, we are in the midst of the Trump administration, in which the priority has been to cut down government workers. That's going to mean a lot of talented labor supply entering the market. What that does for competitive wages from the private sector, we don't know. But it's something that, again, you may be optimistic about, pessimistic about, but it is absolutely a factor. Then we have housing inventory. And this is very specific to each individual market. Some markets are oversupplied, some markets are undersupplied. We do know that overall throughout the country, we have an undersupply. And our population keeps growing. It's hard to consider that housing inventory will cause a housing recession. In some markets, it may take a little bit more time to absorb any new inventory, but I don't see that being a factor long term. Now let's go ahead and look at historically how housing has performed to the stock market. And so if you're an investor, you're looking for the best use of their capital, and there's multiple places you can put your money. If we look at the decade of 2000 to 2010, we can see that stock market downturn had over 15 down cycles versus housing only had one. In fact, every 10 years, housing only has one down cycle. This is when the current price is cheaper than it was earlier in that year. We've only had every decade, you can expect to have at least one downturn. You could argue we're in a downturn now. There's a big difference between a downturn and a recession. A recession is 20% or more. A downturn is simply less than the previous year. If you look at the stock market, you can tell this is a regular occurrence where every decade you can expect to have about 5 or more downturns per year. This is every 2 years you're going to see a downturn. So when you think about where to best put your money, keep in mind that housing is a lot more stable than the stock market. So the question is, why is housing more stable? Well, there are a couple of reasons why. One is people need a place to live. People are actually living in the house, whether they're owning the property or they're renting it out. It's a tangible asset, it's real, and it provides actual value. No one needs a Google stock, right? I can't, if you handed me a Google stock, I couldn't do anything with it. I can burn it and start a fire, but that's about it. There's no other tangible benefit to a stock. It is purely an investment and is based on emotion. Because it's actually so easy to buy and sell a stock, it also increases the volatility, where as soon as someone wants to do something, they can. And housing, if you want to sell your house, it may take several months until it actually gets executed. Same when you're looking to buy. So a lot of research, a lot of due diligence, and no one buys a house or sells a house on the whim. There's usually planning involved. When there is a real estate recession, it usually has to do with outside of real estate. 2008 is the only time that it actually happened where both the stock market and the housing market crashed at the same time. And it was because housing led the recession. But that was a one-off. Most other challenges to the housing is going to come from outside of the housing market. Those are going to be things like economic shifts, high unemployment, rising interest rates. So here's one of the big myths about housing is when we think of it as a market cycle, we think of it as going back to the original point. And that's not the case with housing cycle. What ends up happening is you have a long boom up and you have a decline of 20%, but that decline 20% still leaves you way above where the cycle began. So it's more like a staircase of a little bit. Yes, it dips, but ultimately it's a lot higher than where you were, and you're going to eventually keep going back up. So a short valley is a housing recession. Eventually the incline will be far greater. So the other part of it is that we think of housing cycles as being very quick, and each part of them being equal. Generally speaking, a housing crash is a very short period of time, and the recovery is a very long period of time. So in this chart, we're looking at the housing cycles, the two other previous cycles. Again, this is coming out of World War II after we had the Great Recession. And then we're looking at the housing crash of '08, right, which is a great recession. And you can tell that we're in that orange line right now. We're still recovering from that. So we're still very early in that cycle, and we have a very long way to go. So are we going to experience some downturns? Yeah, right. We can experience that. We know that every decade we're going to have at least one significant downturn, but we're probably going to have another 40 years before we have another great housing recession. This show is saying if we look at historical trends, the ups and downs that happen temporarily are absolutely normal, and they're not significant enough to cause the overall trend to go down by more than 20%. So now we're going to get into my top 8 predictions. Number 1 prediction is we're going to see housing prices rise to about 4%. Now this is going to depend on your region, but you got to take into account that even though some markets are flat, other markets are doing very well. And so some of those markets that did not experience that boom are actually growing pretty rapidly. Places like upstate New York, like Michigan, markets that did not experience that post-COVID boom are now experiencing their catch-up period. They're now catching up to the demand that they missed out on. And so you have some markets that went through that boom, who are now flat. They've overshot their market potential. So now they're going to be flat for a little bit until things recover. But overall, nationwide, I do anticipate that by the end of this year, we're going to see housing prices go up by 4%. So buyer demand will remain flat as long as interest rates are down. And then what we're going to start seeing is, I think we're going to start seeing the reversal of this towards the tail end of this year. And that's going to release a lot of currently trapped buyer demand. What we also see here, and this is specific to Florida, again, most markets did not see a big building boom. Places like Texas and Florida did. So we're looking at Florida specifically here. You can tell that they've peaked building about 2 years ago. So we're actually on that downside. Then we can see this huge swing going down as far as inventory going up. So the inventory we're currently seeing in the market for new construction, this is basically it. There isn't a second boom happening behind this. So when the demand starts going up and inventory starts being eaten away, you're going to end up in a point where you start getting undersupplied all over again. My second prediction is that mortgage rates are going to stay around 7%. I do not see a significant change. They will be a change eventually. It just won't be significant. And so my main reason is that the Fed is looking at 2 data points: unemployment, which has been pretty flat and basic, it's not changed that much. Unemployment has been fine. So there's no real urgency to reduce interest rates based on unemployment. And inflation has also been pretty flat. We have to see what the Trump administration is going to do to inflation. Some people suggest it will go up. Some people say it will go down. We have to wait and see. But right now, it's pretty flat, which means the Fed doesn't have to make a move right now. And if they don't have to do something, they won't. They'll keep with the status quo. Keeping interest rates high allows them to eventually lower them when they start seeing some economic concerns. All right, prediction number 3 is we're going to start seeing moderate growth to rents. For the most part, rents are flat across the country. They shot up quite a bit post-COVID, and now we're in a stage where we're kind of in that catch-up period. I believe that in the back half of this year, we're going to be caught up, and then we're going to start seeing rents slowly go up. Again, market specific. Some markets are oversupplied, some markets are undersupplied, but generally speaking, we saw a big increase post-COVID, and I think the catch-up period is basically over, and we're going to start seeing rents go up towards the back half of this year. So here's what we do with the numbers. When you're analyzing all the places you can put your money, we're going to say appreciation for real estate is 4% and stocks are at 15%. This is the amount that the asset goes up in value. So if you look at this, it seems like initially stocks provide way more appreciation than does real estate. But keep in mind that when you buy real estate, your money goes a lot further because you're only putting a down payment, and then you're able to buy basically 75% or 3 times the amount of house of your down payment. So if you're putting 100K down, you're actually buying a 400K property, and that 400K property is going to appreciate a lot more. So you run the numbers on this based on an initial investment, you're going to find that appreciation in real estate basically is equal to the stock market versus bonds and savings, both at 4%, are going to be around 4,000 for the year. This is looking at appreciation. Stocks only have the benefit of appreciation. There's no other form of wealth creation through stocks. At cash flow, you're going to start seeing about a 6% return on equity. This is cash on cash. That's another $7,000. When you look at stocks, bonds, or savings, there is no cash flow, right? You had all your benefits with the appreciation. There is no cash flow. They're all zeroed out. When you look at the debt pay down, this is the amount that your tenants are paying down your mortgage. You're going to get about 6% debt pay down on your real estate. So in this example, you get a little bit over $5,000. There is no debt in stocks. There is no debt in bonds. There is no debt in savings. No one's paying down your debt if you invest in anything else besides real estate, which is one of the factors that real estate wins across investment options is the debt pay down. That only happens with real estate. The other factor is the tax benefits. There is no tax benefits in stocks unless you actually lose money. There's no benefits in bonds or savings or anything else. There is a significant amount of tax benefits in real estate. Some investors buy real estate only for the tax benefits. In this example, for a typical individual, we're going to calculate that they're going to get $5,000 a year in tax flow. So when we look at real estate, this is investing $110,000 buying a 400K asset. When we combine the appreciation, the cash flow, the debt pay down, the tax benefits, it totals up to, in the first year, your wealth goes up by over $35,000. When you look at putting that same $110,000 into stocks, we only get $16,500. So the difference between investing money in real estate versus stocks is monumental, and clearly real estate wins across the board because there's four ways of building wealth through real estate, only one way of building wealth through stocks, and that's by selling it. And you still have to time it correctly, because if you time at the wrong time period, again, we saw that there's a lot more cycles in the stock market. If you time it incorrectly, we may not even be getting this 15% that we're predicting. And obviously bonds and savings account, they're conservative on purpose. Good place to store your money. You're not really building wealth that way. Okay, so here are a few other predictions that I have. We're going to be entering a renter's market. We kind of been in a renter's market. Until we see rents increase, probably the third quarter of this year is when things will turn. But it's going to be a smart thing for a lot of people to rent. There's going to be a lot of demand for rent. Housing is expensive. Interest rates are expensive. There's going to be a lot more people looking for renting. Eventually, we'll get to the point, I think the Trump administration wants to do this, is we're going to reduce the regulations on construction. The problem is these development projects are going to take so long to kick in that it's not going to provide any relief for anybody looking to buy any properties at the current moment. I think we're going to start seeing the increase of pocket listings. Pocket listings is when an agent sells a property off market. And this coincides with the NAR regulations and just the mess that's happening with realtors overall. And I think this is going to lead to my seventh prediction, which is we're going to see a lot of consolidation and we're going to see a lot more mega brokers. So if you are an investor and you're working with an individual agent, the traditional way, you should know that that agent is not going to be armed the same way that an agent will be who's under a mega broker. A mega broker is going to provide a lot more tools and resources and possibly have a lot more pocket deals for you than a traditional agent. So be aware that the strength will come from mega brokers, particularly as AI looks to step up and play a significant role. We're seeing all the tools and resources going to be consolidated, and you're going to have a lot more stronger forces that are specific to what you were trying to accomplish. But the days of an individual agent being a huge value add to an investor, they're basically over. And my eighth prediction is that Gen Z is going to rewrite the American dream. Gen Z is going to care a lot more about experiences, about traveling, about having more shareable moments with people and experiences overall, that the dream of owning a house is going to seem less important. I think we're going to see a lot more sharing of homes and more renting of spaces. And I think that's going to be a lot more appealing because they're less tied down to a physical property and they're more mobile, right? They have less responsibilities. So Gen Z will be rewriting the American dream. And by the way, home ownership in Europe and in Asia are a lot less than they are in the US. So we're basically going to become more European or more Asian. Now we're going to talk about my convictions in real estate and why I feel confident to buy real estate each and every year. The first fact is very important. 90% of millionaires are created by owning real estate properties. 90% of them. Sure, your billionaires are going to be through owning companies, but the majority of millionaires are going to be through real estate. So if I know this fact to be true, and quite frankly, you can buy one property and wait 30 years and you're an automatic millionaire. So it's super simple to do. It's the number one way of creating wealth, and it's a no-brainer for everyone to do. You just have to buy right and hold for the duration. Second thing is that the reason why I think most people don't invest in real estate is because I think that they're concerned about the risk factors. As I showed you earlier, other investment options have more risk and they have less reward. The problem is that's not being effectively communicated. One of my missions with this channel is to communicate with more investors all the benefits of real estate investing so they can have the confidence to start deploying capital in the number one wealth creator that we have in this country. So the reality is people are scared, they're concerned. And so my mandate is to make buying real estate as easy and as transparent as any other form of investment. If we remove the cumbersome, if we remove the friction involved with real estate transactions, I think we'll get to the point where people will understand the benefits of real estate, reduce the risk factor, and it will reduce the pain point of actually buying these properties. That's all I have for you today. Thank you for watching this video. Now I want to hear from you. Do you agree with my findings today? Do you disagree? If so, I want to hear your comments below. I will be answering each and every one of you, and I'll see you next time.